How low could mortgage rates go before the end of 2024? It's an important question on the minds of anyone who bought a home in the last year and has an interest rate up over 7%, looking for an opportunity to refinance. Anyone looking to get into the market and finding affordability strained. Any decrease in interest rates is going to improve your ability to buy. So join us as we take a look back at what happened last week to move interest rates, where we're seeing them today, and most importantly, what's likely to happen throughout the rest of 2024. So first off, as we jump in here and look, we saw a pretty flat week. You're going to see headlines that rates are their best levels in 6 months. Rates continue to improve. And that is technically true. We saw 10-year yields down 0.05% for the week. Mortgage-backed securities up 24 basis points in price, which will bring interest rates down, but essentially flat. That's less than 1/8%, less than 0.125% movement in interest rates. So what actually moved rates? Really just two big movers this week. We had the first look at the second quarter GDP on Tuesday. It was expected at 2%, came in at 2.8%. Most importantly, in there's a component that tells us what PCE looked like quarter over quarter. And that came in hot at 2.9%, actually made mortgage rates get a little bit worse on Thursday, as there was some fear that today, Friday's PCE report, would also be hot. Turned out to be unfounded. We didn't get as much of the improvement as we had hoped for, but the market continued the slight overall rally for the week as PCE came in at 0.2 month over month on the core and 2.6% year over year on the headline. And it actually, they round those numbers, and it was 0.2 month over month. It was actually 0.186. So when you look at it, we are continuing to make solid progress towards the 2% core PCE that the Fed would like to see. And that absolutely keeps us on track for Fed cuts here later in the year. Most likely in September. We do get a meeting next week. Very unlikely that the Fed does anything, but definitely looking more and more likely that we will see cuts in September. More importantly, inside of that PCE data today, we saw a very important read. There's the component that has remained stubbornly elevated over the last year, while on the ground, shelter costs in terms of increasing home prices and rents has been moderating over the last year. We've seen really, really high shelter inflation as captured in PCE. And you can see here, while it's been trending down over here month over month, we finally saw a pretty solid dip. If that continues trending in our favor over the next 3 to 6 months, we're going to see two things. We're going to see PCE get close to that 2% measure that the Fed wants to see, and the Fed will likely continue to ease to give some support to the labor market as unemployment increases a little bit. So I wanted to give you guys a little different look. We normally show this chart on the daily candles. This is a weekly look. So you can see we're in that green down channel. We're kind of in the middle of it. We're having a heck of a time breaking that resistance to the downside at 4.19 on the 10-year. But we've made a couple runs at it here. It's likely to give way at some point as we continue to see data moving in our direction that the economy is moderating, not overheating, and inflation is in control. So what I wanted to show is kind of stretch this out over the course of the year. We just talked about the Fed meeting this week, probably not going to do anything. But those green arrows there point to the final 3 Fed meetings of the year in September, November, and December. Currently pricing in essentially 100% chance of at least a 25 basis point cut in September. And between November and December, both of those meetings have a greater than 50% likelihood of a cut, and in total between those two, almost 100% chance of one more cut. So expecting somewhere between 0.5% and 0.75% of cuts. So assuming that data keeps coming in our favor, we're going to see the jobs report next month or next week, which you're going to see. We get a Fed announcement, Q&A with Powell on Wednesday. So he is going to give us some insight into what the Fed is thinking and where that goes moving forward. So as long as we see a slowing, moderating economy, the Fed comfortable cutting rates, rates will come down. The Fed does not directly impact mortgage rates, more closely follows yields in the bond market, and they will come down more slowly. But if you look, that green down channel, we need to get below 4.19 on the 10-year. Then the next level of resistance there is 4.07. And when that gives way, 3.85, if we follow this down channel, we hit that level of resistance right about that September Fed meeting. So I would think that we're going to, barring some really strong economic data, either on the inflation front or the jobs front, ride this trend line down, and probably make a run somewhere around September under that 385, or at least down to the 385. So what does that mean for borrowers? It means 0.3% lower interest rates, even if we don't see any compression in the spreads between treasuries and mortgage rates, which over time have been coming down. We're still up around 2.5%. Historically, that average is somewhere between 1.7 to 2%. So not unreasonable to think that between now and sometime in the fourth quarter of this year, you could see rates another 0.5% lower than where they are today. So that gives us a little insight here. 30-year fixed, as reported by Mortgage News Daily, is at 6.86 right now. So you'd be in the low sixes. I think that is a reasonable expectation for sometime between now and the end of the year, assuming data continues to come in line. FHA and VA rates about 6.32. So you could be into the high fives for those two programs that are very, very popular among first-time buyers. Let's look at what happens next week. Next week's an important piece of data, important pieces of data coming next week. We get Case-Shiller and FHFA home indexes coming out on Tuesday. We have the job openings and labor turnover support. It's something important that the Fed looks at to see how many job openings we have, as too many job openings with too few people to fill them is inflationary, as it requires higher wages to fill those jobs. On Wednesday, we get the ADP jobs report. The Fed will have that announcement and Powell's Q&A. After that, on Thursday, we get weekly jobless claims, which are important right now as they have been slowly trending up, and that is indicating some of that weakness that the Fed wants to see to, again, make sure that we're not seeing too much wage-based inflation throughout the economy. Then on Friday, the big one for next week is the monthly jobs report. We saw this week, there's actual numbers, the QCEW that comes out quarterly, and it indicated that we are seeing an overstating of the jobs, or in the fourth quarter of last year, we saw job creation overstated to the tune of about 300,000 jobs, or over 100,000 a month. So that could cast a little doubt on the BLS data. Not that they're cooking the books, but they have a measurement, a birth-death ratio in there that overstates job creation when the economy is inflecting down, and it understates it when it turns back up. So I think people are kind of catching on to that, and we're going to continue to see this slow grind down in interest rates. We've had a couple head fakes. The market jumped ahead of itself. We saw mortgage rates go lower than they should have, faster than they should have, and then end up giving back most, if not all, of those gains. So we're going to see a more moderate pace, and we're likely to just trend slowly down, absent some data, a really weak jobs report. The following week, I believe we get CPI. A really, really benign CPI number could push us. But if you're in the market right now, if you're considering getting a refinance, we would love to talk to you. If you're considering seeing what you can buy, what you can qualify for, if you want a quote, you want a second opinion on someone else's numbers, we do 8 or 10 of those a week, and probably a third to half of the time, we're able to actually help those folks save some money. And those that we can't save money, we can at least give them peace of mind that the lender they're working with has them on the right track. Any way we can help, reach out, josh@bywisemortgage.com. All of my contact information is in the description below. Thanks for watching. We appreciate the support, and we'll see you next week.